Hey, how's it going, Option Sharks? We are back. As you can see, sun is finally out, thank God. Okay, the past week it's been cloudy and windy as well. We still have a little bit of a wind, but the sun is officially out. So I believe this weekend we'll get a lot more sun. So it feels good to get some vitamin D, which is good for you. Okay, so in this video, I want to talk about taking profits and what type of, guideline you want to set for yourself, personal guideline set for yourself when it comes to taking profits. And this past week, I realized that there's some stocks that have good earnings, they're great companies, but they still have a pullback. So in the beginning, you'll see that the trades you do are profitable, but then it just goes south. So I see there's a lot of manipulation going on, and yes, in the stock market there is a lot of manipulation, unfortunately. But you got to know how the manipulation works so you can use it for you and not get caught in this manipulation, and be able to profit from the manipulation. That's a good way to say it. Profiting from manipulation. Let's talk about earnings, right? Pre-earnings and post-earnings. Pre-earnings and post-earnings, there's a lot of volatility on the particular stock. So what you want to do is make your play, okay, and then set a target for yourself. If it's 25% up to 75% to take profits. Because what I realized is that trying to gain and eke out the 100% profit usually doesn't work out so well, because the market is aware of that. So if you are, and I can't say you're trying to be greedy, it's just you would like to realize maximum profit, but it doesn't work out that way, especially when it comes to pre-earnings and post-earnings. So my recommendation, what I'm learning, is you want to go and aim for a target of 25% up to 75%. All right. So when it reaches that target zone, you pick one for yourself. If 25% is good for you, great. 50% is great. But I'll say no more than 75%. Right. So that's the target. So pre-earnings, post-earnings, if you are able to take profits in the range of 25% minimum up to 75% maximum, go for it. Set the bar for yourself. Be very disciplined and execute on that. And don't have the FOMO, fear of missing out, trying to gain maximum 100%. All right, so that's for pre-earnings and post-earnings. Outside of earnings, the stocks and trade normal, you won't see like really high premiums. I would say aim for set the bar between 50% to 75%, right? So you get to 50% profit, profit zone, take profit, 75%, okay? That's outside of earnings. And then, a mentor once told me is that you can never lose taking profits. So I love that, right? No matter what, if you take profits, you can never lose. I have worked with people in the past that share with me, oh, but I would have held it, I would have made more. We can't think about that. What's done is done, but hey, you didn't lose because you made profit, right? So, but the main thing is that understand there is manipulation in the market. Don't try to aim for 100% profit. Aim for pre-earnings, post-earnings, 25% to 75%, and then outside of earnings, 50% to 75%. There's less manipulation when it's outside the earnings, all right? And then, if you like what I shared with you in this video, like and subscribe, leave a comment, I'll always respond. And if you are in the markets, you need some help with options, you're new or you're in the market and you're not, you want to generate 3 to 10% per month, I can be more than welcome to share with you how we can help on a one-on-one base. So the calendar link is, you can book a time in the description. You can click on the link and find a time there, and you'll personally speak with me, and we'll see if we're a good fit or not. And of course, stay tuned for the second half of the video. You're going to see me in action coaching one of my option sharks, and you can see how I'm able to help my members generate income and how I work. All right. So other than that, I wish you a fantastic day wherever you are, and I'll see you on the next one. So very good trades here. Now you're going to coach me, okay?
No.
Right? I'm looking at these contracts here. I can tell the situation with them.
Okay.
But just for fun, like either way, the way me and you working together, I'm like your advisor. I'm going to do everything for you. That's because you don't have to think so much about everything. But every now and then, I do want you to still know and have an idea of what we're looking at, right? So let's just look at the top line, Mara. All right. So the top line here, what's going on with these contracts? How much did you get paid for? And what are they worth now?
I got two contracts.
That's you bought them or you sold them?
We sold puts here.
There you go. Okay. And how much did you get paid?
I got paid, looks like $4 for each.
No.
The contract.
So remember that on the right side, there's the line cost basis. Do you see the 54.65? That's in the same bar as the cost basis bar. If you look at that bar, cost basis bar means what you got paid. Cost basis bar. Okay, I got paid 54.65 at 0.27 per contract.
0.27 per contract.
Correct, and that represents $27 per contract.
$27, which equals double
to 27 times 2 is Yeah,
The
56.
Oh, okay. So this is going to tell me the most.
Oh, 54. Sorry, my math is off. 20.27 times 2. Yeah, that just tells you what you got paid.
Yeah.
Okay, what you got paid or what your cost is. Okay,
Right.
depending on what type of trade it is, because I do see options and I also see long position here. Okay.
Okay.
But either way, okay, great. So that's you got paid that. You know how many contracts you sold. What are these contracts worth now? At this very moment, what is the value of each contract now?
Current value is a -4. So 400?
$4.
$4 per
$4
contract.
per contract. So
Okay.
no, $4 in total. How do you know? Go to the far left. You see 0.02 on the left?
Yes.
No, on the left.
Yes, yes,
Yeah.
yes.
0.02 means $2 because if you move the
Oh,
decimal to the right 2 times, right?
gotcha.
0.02, so it means $2. $2 times 2, because you sold 2 contracts, means $4,
That's the $4.
right? So that means that the value of these contracts now is only worth $4.
Oh,
Okay,
okay.
the value of it. And if you pay the $4 to close the contracts, then your total return will be $50.65, right? Because you got paid $54.65. If you pay $4 to close it today, then your total actual return is $50.65. That's why on the right
It's
it
going
says
to
50.
cost me the $4
Yes,
to
it costs you
close
$4 to
it.
close it today, which is the right thing to do because the most you can realize is $4. So if you hold on to these contracts and let it expire tomorrow, naturally, the most you can make is 4. So that's why when I work with you guys, I tell you guys to focus on closing these contracts early and not wait to make 4, 5, $10. When you can close these contracts out early, release the collateral, and make new trades for the following week and benefit off the premium by selling contracts earlier.
Very good
You
lesson.
understand?
But
Yeah, this is
so,
very important.
and if I rolled it today, is that how I'm realizing it?
Correct. If you roll it today, then you'll pay $4 to
But if
close
I
it.
wait till tomorrow, the most I'll earn is $4.
Yeah, there's no point. Only if you are a very busy professional, okay? If you're very busy, you have no time to manage positions because this is what we're doing. This is managing positions. Then, and you can't look at your portfolio, then you just let your trades expire naturally. And in that case, you'll realize the $4, and then on Monday, you'll make new trades. But if you are a smart investor and you're careful about your money, you would close these contracts out early, pay the 4, make new trades today instead of waiting till Monday and capture the time decay between Thursday, Friday, the weekend, and Monday. And that amount of premiums in those 4 days pays way more than $4.
Right.
Okay? Are you following me now? Are you
Yes.
understanding? So the next line, you're going to do the next line. But for now, we're going to roll this tomorrow. So let's click on that trade 1750 and then hit roll. And we can be more aggressive with this. So we're going to roll to put expiration 25th. No, leave that one alone. That's the close. Right? You see that line? No, leave this one alone.
Oh, sorry.
Yeah, it's the second line.
Expiration.
The top line is we're closing that. The bottom line is the new trade. See, buy to close. Yeah, so new one will be the 25th. Yeah, there you go. And then expiration will pick 19, like what we did on the other portfolio. No, not 1950, 19.
Oh. Stay the same.
Yeah,
We're
but
not
you're moving up your strike, so your collateral is going to go up a little bit, but I think you have enough cash to offset that.
Okay.
And then net amount. Click on net amount. Yeah, and type in 0.38. Okay, let's
So it
process
went down a little bit.
It's okay.
Is that okay?
Yeah,
Now
because we're not
ready?
at mid, but we're a little bit under mid, but it's okay. We can
Okay.
get $38 per contract. And let's see if we can place order. So you make about $75 here.
Okay.
And that should get filled. We'll just close it. We'll just go to the next line and just let it sit there.
Okay.
Okay, that's done. Let's look at HIMS. So walk me through this trade. How much did you get paid? How many contracts did you sell? And what is the value of these contracts now?
Okay, we got paid $196.62 for selling 5 contracts.
Yep.
And they're worth $3.90.
No, $39. Always move the decimal 2 times to the right.
2 times, okay. $39 each. So $39 times 5.
And that math will give you 196.60.
196. Okay.
Yep. Okay. And what are these contracts worth now?
And they're worth 0.06.
Mm-hmm.
And that's only $5.
No.
No?
0.06 means how much? Means
it'd be $6.
$6, right?
$6.
$6 times how many contracts?
Times 5. So it'd be
that's 30.
30.
So if you look at that, there you go.
That's the current value.
There, you got it. It's worth $30.
Okay.
You get it?
Yep.
Yeah, and then if you take 30 minus 196.62, then your actual take home is 166.62,
Right.
which is the box to the left in green.
Right here.
That one, no, that one.
Yeah. If we let it expire.
If you let it expire, what's the most you can make?
Uh,
What's the most you can make that's unrealized?
it'd be the 166.
No, it's right now the current value is $30.
Oh,
So if you let it expire naturally, what is the unrealized value if you hold it till expiration?
30 times 5, right?
No, just $30.
Just
Because the
30.
contracts are worth $6 per contract. 6 times 5 is
Oh,
30. The
of
unrealized
course.
value is $30.
Okay, you better do this with me
Yeah,
every time. I'll get it. I'll get
yeah,
it.
no
It's
worries, no
taken me
worries.
longer.
It's okay. It just
I
means that
don't.
if you hold on to it, the most you can make is $30. Okay.
So we
And in
want to
this case,
roll this one too. I would
yeah,
roll.
we're not gonna hold $30. Like this is a waste of time.
Right.
So let's just roll this out. So let's hit roll. And we need to change the strike price though, because the stock has moved up. But if we keep the same strike, then you don't have to move your collateral. So we may have to keep the same strike, July 25th. And then you can select 44. Yeah, there you go. Okay. Now the reason why you select 44 is because your buying power is very low. So when you move up
Okay.
the strike price, you need more collateral to open the trade. Okay. But in this
Okay.
case, we're not able to. So we're just gonna click on the net amount. Unless you have more capital laying around that you're not using, I recommend you put it to work because right now is the earning season. Now it's time to make money.
Okay.
I will put 0.25. So you can, when we finish this session here, you can decide if you do want to put more capital, which I do recommend because it's a good time to make money. But by doing this, we're just keeping everything the same, but moving it out and get paid about $121. Now, obviously, if you have more capital, you can make probably like close to 300 to 400 here. I'm just place order on this one, and that should get through. I'll just leave it alone. It's gonna let it do its thing.
Okay.
The Archer call is in the money, so we need to roll this the same thing that Archer call. Oh wow, it's 45 contracts, so we need to roll this out. Roll, and then we chose August 15 on the other portfolio. So let's go to call expiration. No, not that one. The box below. 8:15. Yeah, go down. There you go. And we'll go with a strike. I think we went with 15. Yeah, slow 15 strike. Yeah, that's about. You're gonna pay a little bit of debit here, but it's okay. We want to pay that to move up. So hit
Okay.
net amount. Yeah, 0.02 is fine. Yep. Okay. Pay about 120. But it's okay. It's worth it. And the space order on this one. And then we'll just leave it to see if it gets filled later on.
Okay.
And then the Palantir is good. Archer is good. Look at the Archer. You're up 22,581.
Yes. Look
Both
at that.
portfolios, you're up 20. You have, was it 14 or 15,000 the other one? 22 here. So you're like 37,000.
Yes.
And from, if you combine both portfolio performance, you're up 37K just off one position. That is tremendous.